As the long-term average is getting closer and closer to 25, you have a very healthy market. You have a lot of people saying, oh, this is a great opportunity to sell, or this is a great opportunity to buy. And I just think that's what you're seeing. You're seeing a healthy trading environment.
Rob Hocking, Head of Derivative Strategy at Cboe. Thank you very much for joining us today.
My pleasure.
Tell us a little bit about your role at Cboe.
So as Head of Derivative Strategy, I mainly run, call it product development. That's probably the easiest way to describe it. As our customers want changes to our products or new products, then they come to my team, and we're kind of the creators at the exchange.
Now, your customers, are they other financial institutions, but do you also have corporates as well who are looking to try and hedge out certain things?
So yeah, our customer base is pretty much anyone that trades within the markets today. So with the focus on derivatives, it's, call it buy side, pension funds, insurance companies, if you look at the sell side, banks, hedge funds, all the way through end retail clients that are trying to trade Tesla options or Amazon options. And then also
but on commodities too?
We are primarily, for the most part, Cboe Global Markets. As we've expanded, we've made a lot of acquisitions as of late. We've gotten into most all markets, but I would say where my primary focus is the equity markets.
Okay, on equity markets then, this was something that when I was looking at stock markets was a reference that people sometimes had, which was the CFTC report of open interest. So to the extent that you have a view into derivatives on equity markets, is that a good and a viable way of just, at least, I'm not asking you to call the markets, Rob, but is it a good and viable way of just seeing what positioning is like in the markets at the moment?
Yeah, I think open interest is a good way to do that. You can see where people are positioning, if it's downside puts, if it's upside calls, where that balance is, to try to gain a perspective of where people are positioning and what moves they expect. For instance, like we also look at levels like the VIX. At a 25 vol, that implies roughly a 1.5% move a day. So at an S&P level, let's call it 4,000, it's a 60-point move a day.
Okay.
So you combine what's the market implying, like what sort of move are people predicting by backing out the volatility levels of the prices that are trading, combine that with open interest and where that positioning is, and you can get a pretty good idea what the market's telling you, what it's expecting.
Maybe there's been less disruption than it feels like, but so far in 2022, feels like there's been a lot of disruption. And I think many, including myself, are surprised the VIX is maybe not higher. Is that something that surprises you too?
As a former trader, I think I always look to the markets as being fairly priced.
Very Chicago.
Yeah, most everybody, everybody coming into the markets, you kind of find that equilibrium. So I'm not surprised. I would say a VIX level over 25 is very hard to sustain. And the VIX tends to be a mean reverting index. And historical levels of vol, if you go back even since the VIX inception, has been anywhere from, call it 18 to 20. I think we're trending higher because we have an extended period of time here where the VIX has been higher, but call it a long-term average of 20. That 25 is always going to have pressure to move back towards that 20 long-term average. So the fact that we've sustained, call it a 25, and even touched on 30 kind of level for as extended a period of time as we have, it signals that there's a lot of volatility in the market.
Right.
But no, I personally don't expect it to be higher.
But do you get a lot of clients who are actually trading derivatives on the VIX to protect themselves?
Yeah, 100%. We have a lot of clients that are using the VIX index itself as a signal and trying to anticipate as it moves how they want to reposition. We have clients that are using, whether it's futures on the VIX or options on the VIX to hedge the volatility of the market itself. A good way to look at that is kind of the VVIX. So it's the VIX on VIX. That kind of tells you what's the volatility of volatility. And as that number moves around, you can also see people fluctuate and using VIX options very regularly on how they're trying to kind of trade that vol number.
So you talked about who some of your clients are, whether it be all the way from retail up to large-scale pension funds. What kind of product development are you working on, and what kind of solutions are you trying to solve? What kind of problems are you trying to solve?
Sure. The biggest is access. And what I mean by that is as we expand and Cboe becomes a much more global company, accessing our products around the clock is higher and higher in demand. So recently we've launched.
So what are they currently now? What are the times that you
So
can access?
just recently here we launched 24/5 access to SPX and VIX options, and so with that you're basically trading around the clock. You have access to these products. Whereas if you look at a single name equity, as I mentioned Tesla before, that's on a U.S. market time clock. So call it 8 o'clock to 3 o'clock Chicago time. So with 24 access to the larger index products, the ones that are used for more global hedging, that obviously helps people around the world.
Right.
And
okay.
so that's been a big focus, is the access. In other areas where access has been is shorter duration trading. That's another huge trend that we're seeing in today's market. People want to trade much shorter duration, whereas maybe a few years ago.
What's driving that? Is that just interest rate outlook is just looking less
To be honest,
clear?
it's a great question. I mean, we could debate it. I'm not sure I have the answer. I think what's driving it is people want instant feedback. People want that instant positioning. Like when you have call it 60 or 90-day options position and you get a large market move, you have to reposition. You're either rolling that position around relative to where the market moved, or you're using shorter duration options to kind of hedge that 90-day position. Now, as you see this trend to, I think it was in 2021, 46% of U.S. options traded expired in 5 days or less.
So say it again.
46% of U.S. options traded
Right.
expired within 5 days.
That's incredibly short
In
term.
2017, that number was around 24%, I believe. So you're seeing a huge shift towards more near-dated options trading. So what happens, you get that same market move, and now that option position moves to almost 100% intrinsic. So it's moving almost one-to-one to the underlying. It's actually almost working like the underlying. And now that repositioning need kind of goes away. You more just let it expire, and then you wait to reposition again. So it's just, you're seeing liquidity and positioning all en masse much more, closer dated than you've historically seen in the past.
Do you think having access to that market 24 hours a day is just a huge appeal versus the equity market, which is obviously just, 8 hours a day or whatever it is?
That's the feedback we're getting, yes,
Right.
is that people just like that. I mean, a lot of these moves are happening because the call it global interdependence, these moves are happening off U.S. market hours.
Right.
So when that risk moves in your portfolio, you want to be able to hedge it right away instead of waiting until the U.S. market opens. So with us having that 24-hour access, it just gives people that kind of safety blanket to know, okay, if the market moves, I can reposition if need be. And then lastly, the one I also want to mention is, because we're obviously focusing more on institutional, but there's a huge retail component that is becoming more and more, call it vibrant in the markets. With them, access has been for, call it smaller notional products. I think, what was it, the stat? I want to say it was a Robinhood stat that was out there that 88% of Robinhood customers don't use options. So we as an exchange see that as a huge growth area. Like obviously options can benefit everyone and you don't have to be an institutional player. And so with growing into that market, a lot of the account sizes for customers, say at Robinhood, some of the other retail brokers, you see in the news that they're smaller account sizes, call it $5,000 or less.
Yeah.
Well, when you have big index products like the SPX has call it a 400,000 notional contract level. SPY options are around, call it 40,000. That's a big contract to trade if you're new and you have a $5,000 account at, say, a Robinhood or a Webull or so forth. So we recently came out with a product called Nanos, which is a 1 multiplier option as opposed to 100 multiplier, which is a traditional option. And with that, it gives you the ability to trade an at-the-money option for, call it around $5. So you can start to trade and you can start to learn how to use options without using large sums of money.
Right.
Which we view as a huge tool to getting people comfortable and then expanding over time. As they get more comfortable, we think they'll trade more and almost even graduate to the bigger and bigger products as they go.
Yeah.
But you really need that kind of short-term thing. I equate it to, I was a basketball player growing up, and it's like you walk into a rec league game and you see Lebron James lacing up his shoes across from you and you get all nervous because you're like, I showed up to play rec league, I didn't show up to play against LeBron James.
Right.
And if you look at the option markets in the same way, it's kind of like you show up and there's a lot of professionals in that space. It's nice to have a smaller product that's more geared for you so that you can learn and experiment with.
I can't remember who said it now, but they said you can learn more by just trading like one future than you can at like a year at a business school, because you need to be able to get out and do that. So if you can access those markets, then you can learn on the job. But what I always thought that one of the sort of barriers to entry for a lot of retail people is bid offer spreads on some of these derivatives. Puts options were very wide. So like, you know, the stock could not move and you still lost 5% or 2%. Can you just explain how that works? Like how liquid are some of these markets? I'm assuming on the exchanges, bid offer spreads are very, very tight, but are they still quite wide on stocks? Or?
I mean, it all depends on the underlying, depends on the day even. The bigger, call it SPX, and the bigger index products are very liquid. If you need to move large sums of risk, they're there, and generally the liquidity providers are standing ready to do that. And some of the smaller names, it just depends what's hot and what's not in a way, and where the liquidity goes. If you think from a liquidity provider position, you have a finite amount of money and you go to where you can make that spread. And so the hot names tend to get better liquidity, and that's where it kind of aggregates. But with regards to the bid ask, yeah, most situations you have to build that into your pricing of where you want to get in a trade, where you want to get out of a trade. And then based on that, you figure out your entry and exit points and go from there.
There's a lot of people who be trading their raw portfolios at home, and I know for me, when I was looking into the options market, which I do some now, just feeling that you don't know as much as the next guy. Someone once said to me that trading the markets is one of the only sports where you immediately play with the professionals. Going back to your LeBron James thing, it's like you don't turn up and see that LeBron James, he's always there. Like you are trading exactly the same stocks as people who know more than you, and it can be quite an intimidating feeling. So just, I think there's a lot of first-time investors out there who look at derivatives and options and think, you know, why would I ever trade these? Because I'm not the smartest guy in the room, and I want to have some kind of edge. So it's like, how do I start to trade these things and become used to how they operate?
I think maybe a good pivot on that is, why would you trade some of these things? So I look at a nanos trade and I look at call it a deep in the money call, which will move very similar to the underlying stock. But say the underlying in the S&P 500 is a $400 share of SPY. Now you can spend $20 and get a very similar upside risk profile as you can spending $400 for a share of stock. Now, where the benefit comes is if the market goes against what your initial intuition was, the most you can lose on the options trade is $20.
Yeah.
Well, your $400 stock investment can continue to lose until you decide to close out of it.
Yeah.
So the one nice thing that options provide is kind of this asymmetric payout, and it's also another reason why a lot of these funds that have come out, you hear the defined outcome funds. It's a big kind of tagline that you see, a lot of the ETFs, defined outcome funds. A lot of that is because people, through options, you can define that outcome before you start. So it's like I talk to my friends and family, neighbors, and it's like, okay, what's a favorite stock you like right now? And I'll keep going with Tesla. So he's like, I like Tesla. And it's like, okay, well, you bought Tesla here. Would you be happy if Tesla went up in, say, the next, call it 30 days, if it went up 10%? Yeah, of course, love it. What a great investment. That annualized is a humongous return. It's like, okay, well, if it went up more than 10%, would you be willing to give away that additional upside to collect cash today? Most people say, yes, of course. Like I make 10% in a month, I'm happy, and if I can collect a little upfront money, great, I'm even happier.
Yeah.
That's what options can do. So you own that underlying, you can sell an upside call, you give away that any incremental, anything above that 10% of return, say you're giving it away to collect cash today, and the likelihood of, let's say, Tesla, rallying 10% in the month is not huge. Maybe it is. I don't know, in this market, it's probably better than most.
All over the place, but going more than that is unlikely.
And as long as you're okay with that going into the trade and you've defined kind of your entry and exit point, you can enhance that return by using options and overlaying them.
Yeah. So for people getting into the world of derivatives now, what other what kind of other factors do they need to be wary of? I'm actually thinking about expiry. So in and around expiry, are there anything that people need to be thinking about or concerned?
I mean, yes, obviously, talk with your broker to make sure you understand those pieces. There's nuances across, in single name options, like we're talking Tesla, those are all physical delivery.
Yeah.
So you trade the option at expiration, they turn into shares depending on if the option's in the money, out of the money, so forth. The nice thing with the nanos trade and is they're cash settled. So ultimately, at the end of the day, wherever it settles relative to where you put on, you're either getting cash taken out of your account or you're getting cash put into your account, but there's no having to deal with the physical shares afterwards. So we view that as a huge benefit to a new trader coming into the market, experimenting with options, that the cash settled takes some of the complexity out of it. But other than that, at the Options Institute, which is the education arm of Cboe, we're constantly trying to offer more materials to help educate people around whether it's settlement of a physical, whether it's settlement of cash, option strategies, how people are overlaying, like the example I used before, and just trying to raise the overall education level of the market.
Which I guess is only going to help the retail investor becoming more comfortable with using options and derivatives.
That's right. I think that's the number one thing we hear is that, yeah, I love the concept, I'm just not confident enough to use them. And so anything we as an exchange can do to kind of raise that confidence level is beneficial for the market.
So where do you think the VIX is going from here? I'm just kidding. I won't want to draw you on that. Rob, it's been such a pleasure chatting with you. Really great to have your insights, and thank you once again.
Yeah, thanks for having me.